which has been now uploaded on the stock exchange website. The transcript of this call will be available in a week's time on the company's website. Please note that today's discussion may be forward-looking in nature and may be viewed in relation to the risks pertaining to our business. After the end of this call, in case if you have any further questions, please feel free to reach out to the investor relations team. With this, now I hand over the call to Mr. Rahul Guha to make the opening remarks.
Thank you, Prateek. Welcome, good evening, and welcome to all on the call. Thank you for taking the time out from your busy schedules to join us this evening. Quick introduction of those of us on the call. My name is Rahul Guha. I'm the MD and CEO of Thyrocare, and I thank you for the opportunity to present the Q2 results for FY24. I'm joined with my colleague Alok Jagnani, who has recently joined us as our CFO. Additionally, Prateek Hire, who you heard, is part of our strategy team and leads investor relations, and is with me along with Aditya Shinde, who heads our finance, admin, and sourcing function. Before we begin, as with all my calls, I will always start with a quote, but this time from Nelson Mandela in recognition of our foray into Africa. It is in your hands to make a better world for all who live in it, and we believe Thyrocare can bring our business model to Africa to make affordable and good quality diagnostics available to all. With that, I will give you some key highlights of what we have been up to in the last quarter. Before we get into the details of the quarter, I'll reiterate our pay-for-performance pricing structure that we implemented at the beginning of this financial year. Earlier, our discount structure was one-size-fits-all, but now we have moved to a slab-based pricing model, which we implemented in May 2023. This has led to an increased energy with our franchise network, with motivation to move up volumes and enter higher slabs. This has resulted in both volume and value growth in the last 2 quarters. As always, we continue to selectively expand our offerings. Arogyam, which has been our flagship brand in the preventive healthcare segment. As I've discussed in previous presentations, we have 2 more brands. Janch, which is our diagnostic or illness package offering, and HealthCheck, which is focused on women and largely focused in the maternity and women's health space. Janch, as I said, is targeted towards lifestyle challenges for you to better understand your health. We have solutions across the spectrum for anything you might be worried about, whether it's fever or something more serious, hair fall, cancer screening, as well as deep investigations for common chronic diseases like diabetes, heart health, amongst others. Janch is already doing 1 crore of monthly business. We have revamped our Gynac portfolio and relaunched it under the brand name HealthCheck, which is focused on women's health. Our partnerships business, excluding API and the government business, continues to do well as we grow existing accounts and add new partners. On the government side, I'm very happy to share that we have been awarded contracts for TB testing in the state of Gujarat and Assam, and the work has started from this month. On the international expansion side, we have signed the JV agreement and the company has been incorporated in Tanzania. Our plan is to be operational in the Tanzania market by the beginning of the next financial year. As I told last quarter, we have revamped our equipment platform. Our equipment was quite old with an average age of 12 years. We have added 24 new machines from our vendors, bringing our average age down to 6 years. These new additions have dramatically improved our reporting accuracy, performance, and turnaround time. As you would see in the financials, we have financed these machines over a period of 3 years. As we get into the results, I wanted to share with you a few highlights or pointers before we deep dive into the same. Our franchisee business showed a strong revenue growth of 20% year on year, and while our partnerships business saw a decline because of API and the closure of our MCGM contract, our partnerships business, excluding API and B2G, showed a strong revenue growth of 22% year on year. The API business, while degrown year on year, has now stabilized quarter on quarter at a quarterly run rate of 12.7 crores, which is a growth of 5% quarter on quarter. Our radiology business did a revenue growth of 20% year-on-year, which includes our new foray into full-scale radiology through Pulse High Tech. Overall, we did a 10% year-on-year revenue growth on a consolidated basis. With that, I will hand over to Alok to take us through the results.
Thank you, Rahul. Hi all, good evening. Thanks for this opportunity. I am very excited and thrilled to present my first financial highlights of Thyrocare. I will briefly update you about the key highlights of Q2FY24 financial performance. Before we get into the details, I will reiterate about the ESOP program that we have been mentioning in the last few quarters. This program has been introduced at group level to retain talent at Thyrocare. These ESOPs of parent company will vest over a period of 6 years, and we are recognizing the same as per Ind AS IFRS as a book entry to our share-based payment and appropriately reflecting in profit and loss account as an expense and balance sheet as a equity contribution from parents. The total value of ESOPs granted are 45.53 crore over a period of 6-year period. But one thing we must note that this is a cashless transaction and there is no cash outflow going to happen. As per the Ind AS, the options are valued at a grant period as per Black-Scholes formula, which is charged to P&L over a vesting period proportionately, and typically it results in a hit in the year of the grant, then proportionate charge over the vesting period. The breakup is included in the presentation. As these are not operating expenses, do not impact the cash flow of the company, we have normalized EBITDA, which takes into account along with the provision of bad and doubtful debts. Now to go into the performance. Our overall revenue saw a growth of 10% year-on-year, driven by 20% growth of franchisee business and around 22% growth in partnership business, excluding API and B2G. Our employee benefit expenses have increased by 1.3 crore versus last quarter, mainly on account of actuarial valuation impact on leave encashment and gratuity, which may be a timing difference and expected to be actualized in a subsequent quarter based on the actual leave availed by our employees during the festive and holiday periods, which are in Q3. Our other expenses overhead has increased by 4.8 crore versus last quarter on account of increased spend on business promotion expenses, loss on sale of end-of-life assets, and one-time legal fees and some other IT expenses. As far as the EBITDA margin is concerned, our standalone normalized EBITDA margin remains flat at 30% compared to the same quarter last year. EBITDA margin in NHL stood at 6% versus 17% YOY, mainly due to the 8 machines coming out of the CMC period and increased transportation costs due to the increased volume of FDG and plasma sales. Our consolidated normal EBITDA margin remains stable at 29%, same quarter last year. With this brief highlight, I will pass it on to our MD, CEO, Mr. Rahul Dua, for the strategic update. Thank you.
Thank you, Alok. Briefly, I would like to take a few minutes to recap to you our strategic direction, and then I will open it up for Q&A. First, I will reiterate our value proposition to the customer. We will continue to remain an affordable option to all patients with good quality and on-time reports. All our efforts on our value proposition is towards they can serve their patients in the most effective manner. If they require phlebotomy, we are happy to mobilize our phlebotomy network of almost 900 companies and 400 network phlebotomists to serve them better. This strategy has been working well for us with our franchise business at an all-time high again, and hopefully the headwinds in the e-commerce space will abate and our partnerships business will be on a strong growth trajectory once again. We remain true to our strategy. We have 3 key pillars of growth, which I have shared in the last few quarters. I will reiterate once again. We are focusing on 3 areas. The first is our franchise business. The focus is to take our franchise business deeper into India with a focused test menu and provide our clients with a frictionless experience to transact with us and provide their customers the best testing experience that they can. We will continue to focus on private as well. The second area is where we will focus on our partnership. We continue to focus on private as well as public partnerships. In the public space, TB and infectious disease, which is our focus, where we are by far one of the strongest players in these segments, where we have won tenders now in Gujarat and Assam. Additionally, we will continue to expand our partnerships across healthcare companies, hospitals, and other health services companies, and enable them to provide diagnostic testing to their customers. The third area is new for us. We believe we have a strong and robust B2B model with a core of execution. We are ready to take this model forward with our first entry in Tanzania. Able to launch. I'm happy to share that the Tanzania has been incorporated. That in a brief is our mandate as management. Thank you so much for giving us a patient hearing. As always, I will end once again with a quote from the Mahatma. Find purpose, the means will follow. And our purpose remains to provide high quality, affordable testing to the masses. With that, I'll open it up for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star. Ones are requested to use hands. That's why, ladies and gentlemen, we will wait for a moment while the question. First question. Please go ahead.
Good evening. Thank you for the look and best wishes to you. Could you please contract and how does the business?
So it's I think we'll go after more.
This is 4.5 crores and working capital side. Which is sustainable level. Once we get whatever outstanding payments we have with the government on a sustainable basis, our net working capital cycle should stabilize at what level, sir?
So, firstly, I think we've received most of our government payments, and overall, I'll let Alok take this. Alok, why don't you take it?
Thank you, Rahul. So, on the trade receivable and the working capital piece, Rahul, we are expecting that on an average, trade receivables are going to be around 90 to 120 days outstanding because it's going business. We have a business agreement which is between. It's going to be a 3-month.
I'm hopeful if we are able to sustain the growth into next year, you will start to see operating leverage kick in. It's too early to comment. Maybe towards Q4 results, I'll start to give guidance for next year. But I'm hopeful that next year we will start to see operating leverage.
Okay, so anything about 30% of EBITDA margin would be invested in marketing. That's what you're saying?
Yes.
Okay, yeah, that's pretty clear. My next question is, so for the radiology business, up to what level of revenue would the operating costs not increase? Like right now, the revenue has been quite flattish for some time of 10 crore this quarter as well. And the operating costs are almost 70%. So what is the level of revenue where the operating costs will not increase?
See, the operating costs actually in our nuclear business is by and large fixed. The main categories of operating cost in our nuclear business, if you look at it, is about 8 crores. Most of that is actually CMC cost, rent cost for the locations. CMC is the maintenance of our PET CT machines. Then we also have rent at those locations plus the staff at those locations. So I think a large amount of our cost in NHL is fixed. So I would say of that 8 crores, almost 4 crores would be fixed. The rest is commission that we pay to our centers where we have franchisees, right? So that is linked to the revenue. My sense is actually we should be at a healthy, profitable level once we cross 12 crores a quarter.
So when will that happen? Because it has been quite flattish since quite a long time. So when will the business grow? Because it is not able to grow as of now.
No, actually that's not true. If I look at, last year we had grown on a very high base, right? So if you look at our last year, full year consolidated growth rate for nuclear, I think it was 40+% on a revenue basis. So, and in this year, yes, it looks like about 10% year-on-year growth, but it's off a very strong base of last year. And what has happened is, not all our centers are still operational. So as we get one or two more centers operational, you will start to see the growth rate come back in this business. I can't give you specific guidance on when we will hit 12 and a half. I think I am hopeful that by the time we enter the next financial year, we should be there.
So by 25, FY25.
Yeah, I would say you can take almost it by, I would anticipate by the first half of 25, we should get there.
Okay, got it. And in the other expense, you mentioned that there were some one-time expenses of legal fees. So what was that quantum?
So there are two one-time expenses in other expenses of the tune of 1.5 crores. 1 crore is because we had very old equipment which we sold at scrap value. There was a residual, value attached to that which we charged to the P&L. So that was 1 crore. And the legal expenses of 50 lakhs, which is largely linked to our outstanding, international outstanding.
So is it recurring?
No. One time.
Okay. Got it. Yeah, that's all from my side. Thank you.
Thank you. Before we move on to the next question, a reminder to participants to press star and 1 to ask a question. We have our next question from the line of Ankit Pandya from InCred Asset Management. Please go ahead.
Yeah, hi. Thank you for the opportunity. Firstly, on the provision for receivables, from March quarter to from the first half, we have seen a reduction in the receivables from 85 crores to almost 55 crores. But yet, on the sequential basis, the provision for receivable is yet there. So any particular reason we are still charging for that, accounting for that?
See, we still continue to have government receivables which are long outstanding. And as per our provisioning policy, we are following the policy strictly, which is a certain point of outstanding, we on a conservative basis, we provide it in the P&L. So until we finish all the government receivables, I think that provision, as it is there, it's of course substantially reduced to, let's say, what it was in Q4 of last year. But the tail end of our government money is still pending. So as per our own policy, we provide for it in advance. However, we're still hopeful that money will come because these things take time.
So, and from last quarter, I think you mentioned that around 38 crores has been received, 35 or 38 crores. So what will be the balance amount from the government?
The total balance amount pending from the government is about 10 crores.
10 crores. Okay. Then lastly on the capex fund, so there's just wanted some clarity. So on the cash flow, it's mentioned that around 46.9 crore capex has been done. And we have in the last quarter, Q1 quarter, you had guided that around 40 crore capex for FY24. So just wanted to get some clarity what capex can we assume for FY24.
Sure. Could you just, because your didn't come through clearly, could you just, your question was, what did you spend the 46 crores on?
On the capex.
To spend additional capex?
Yeah, 46 crores of capex has been spent in first half 24. And in Q1 call, you had mentioned that for full year, our capex will be around 40 crores. So just wanted some clarity on the capex fund.
Acha, okay, no problem. I'll give you at least a view on what we are planning to spend our capex on, and then I will ask Alok to reconcile for you the first half. So look, first half actually a lot of our capex went towards plant and equipment and some of the office refurbishment and all of that. I'll ask Alok to take you through the details. In H2, actually, majority of our capex investment will be in the maintenance capex area. We expect to spend about 5 more crores on some of the older machines in the lab and also overhauling our IT architect infrastructure of another 5 crores. So, and then I think we will have our international expansion in Tanzania where the lab is getting set up, which I think we will incur another 10 crores. So in the second half of the year, I would anticipate about 20 crores of capex to happen. In the first half, I'll ask Alok to take you through the, what has the 46 crores break up more or less.
So in the cash flow, like you have seen that around 46 crores of capex investment was happened, and mainly on account of like Rahul said, that around 25 plus machines which we have replaced over a period of last 6 months, which required a capex, and around 16-17 crore of capex investment has happened on account of that. We have invested on lab infrastructure facilities and expansions on efficiency. Around 16 crores of further investment has happened on account of that. And that is on around 33 crore of total investment. Rest is the capital advance for other business plan which has been given.
Okay, fair enough. That's it from my side. Thank you.
Thank you. We have our next question from the line of Girish Bakru from OrbiMed. Please go ahead.
Yeah, just want to check. So these new packages, Janch and Health, is there a major overlap with Aarogyam? How are they exactly different?
No, they're very. Firstly, nice to see you, Girish, on the call. And just to give you at least the overall strategy, see, we have a routine test and semi-specialized test. Aarogyam is largely a annual checkup, preventive wellness brand, right? So it is focused for people who would like to do an annual health checkup. The problem with annual health checkup is it is only once a year. Janch is really focused on the therapeutic side, right? So it is think of it as a consumer-facing therapeutic brand. So, for example, if you have a fever and you're worried about whether you have malaria, right, then you would do Janch fever. If you are, let's say, having hair fall and you feel that, there is something wrong with your body for hair fall, so you would do Janch hair fall. Similarly, we have Janch diabetes, Janch healthy heart. So if you're worried about heart attack risk, then you would use Janch healthy heart that gives you a 360-degree picture of your heart health. Right? So Janch is very therapy specific and largely focused on lifestyle and chronic diseases. We have Janch cancer, we have Janch pollution, and many other kinds of segments, Janch STDs. So it's really, the way to think about it is Arogyam is your annual health checkup for a full body. Janch is really therapeutic focused if you are worried about the detrimental effects of any lifestyle disease or chronic disease that is there in your body. HealthCheck is a pure women's health package. It is largely focused for gynecologists. It has two main legs, maternity. So all the maternity tests, double marker, triple marker, NIPT, everything that, goes in the section of maternity, all the way to newborn screening and so on, is under the umbrella HealthCheck. And the other area is infertility, which is really about, doing investigations to understand the reasons for infertility. And that covers the whole gamut of infertility as well. HealthCheck is largely focused on gynecologists to treat women. So that's how you should think about the three brands. Arogyam is the annual health checkup wellness brand. Janch is the therapeutic chronic disease focused brand, where if you're worried about something, you do a Janch. And HealthCheck is largely for gynacs to help them manage women's health.
Thank you, Rahul. That's a very detailed description. So when we look at these new packages, would it be fair to assume there are certain tests which you have, let's say, maybe introduced or they were in the panel before, but they were not getting scaled up? So is there a higher mix of specialism expected with these packages increasing in the overall contribution?
Yeah. So just to give you a sense, our average Arogyam package to the B2B channel, right, which is where we sell, or actually let me not comment on my B2B rate. Our average Arogyam package typically operates at a 1,400 MRP in the market. Our average Janch package actually operates at closer to 2,000, and so does HealthCheck. So I think these are two strategies also to move the mix upwards.
Understood. And what would be your, let's say, target to revenue for these packages put together, let's say, fiscal 25-26? Any ballpark number?
See, HealthCheck is actually still too new. So, we are still promoting and marketing it at this point in time. So it's too early to comment on HealthCheck. Janch has beaten all our expectations. I think within 3 months of launch, it has already touched 1 crore a month, right? I'm hopeful by the end of the year, we should be able to double it. So I would say between 25-30 crores is what you can take as Janch as our target for next year.
Understood. And just one more on the expansion strategy. You talked about, of course, international and B2G now coming with these contracts. What about the hospital channel? I mean, that you had mentioned in the past that maybe small hospitals, less than 100 beds, could be a potential target. Are they still accessible?
Yeah, we've been working on the hospital space, I think now for about 4 or 5 months. To be honest, I mean, it is not scaling as per the expectation because it does take a long time to convince the hospital to hand over their lab to us. At this point of time, it's not material. We only have 2 or 3 hospitals, but we are learning the business with the help of this.
Understood. Thank you.
from the line of Amit Agarwal from Nirvay Investment. Please go ahead.
Hello. My question is regarding the term loan we have taken for the business. Thyrocare has always been a very cash-rich company. So what is the need to take this term loan, and for how long this loan has been taken? And do you think that this will be the unit practice in future also? And regarding the capital expenditure, 47 crores, this company has been always less capital-intensive business. So what is the change in the future plan, business plan? Because I think cash is becoming there now.
Sure. Maybe first I'll just share a bit of philosophy, and then I'll ask Alok to cover the details. See, I think one is to use equity to fund equipment. In my mind, yes, it is debt, but I mean it is not bad debt. It comes at a quite a reasonable cost, and helps us overall expand the business and be more prudent about our capital allocation. So as a philosophy, we didn't feel it makes a lot of sense to deploy equity capital to fund equipment, right? And so therefore we looked at loans and we said, how best can we leverage the debt market rather than deploying equity capital? That improves the return for our shareholders and everybody. And the amount of equity that remains with us, we can deploy it to fund much better avenues of growth and hopefully grow the business faster. So with that philosophy in mind, we decided to take the loan to fund our equipment. I thought it was quite an attractive value proposition. So I'll let Alok take you through the details.
I think almost Rahul has covered, and we all know that debt is lesser costly as compared to the equity, come at a higher cost. And we have taken around 30 crores of loan in our financial books, which you can see all against the plant and machinery, which is going to have a tenure of 3 years. And it's a very reasonable best rates what we have taken. And this gives a leverage to expand our business and cash in our hand to further expand and opportunities in capex and business expansion piece, which is like other expansions we are doing.
So you mentioned we have taken almost 16 crores for capital advances. So could you explain that item more? Because 246 crores for capital expenditure has been a huge amount, and we have always been a very less capital intensive business. So because I think there is a change of model of business right after the change of the management.
So wait, first let me take the first question around the change of business model. Look, as I said before, our average age of equipment was 12 years. Okay, it becomes very difficult to run reliable testing on equipment that is so old. We had to replace that equipment to ensure that we could have much better accuracy, throughput, and performance. So that was a need of the hour for the business, to ensure that we have the right equipment so that we can give our customers the right and most reliable testing. So that decision to replace the equipment was not a change of business model. It was the need of the hour to ensure that we improve our accuracy and reliability in the lab. Now, how we chose to fund it, that I will let Alok take over.
So like the funding piece we've already explained. So the total spend of capex and investment what we have done till in H1 is 46 crore rupees, what my friend, Incred friend has also asked. So we have spent on the machine expansions and replacement of existing old machines with the new machines, and around 24 machines has been replaced, which resulted a spend of around 16-17 crore rupees. We have our labs also require some infrastructure and improvements, and we have gone for the infrastructure improvement and expansion, and that leads to a capex advance of around 16 crore, which are going to be capitalized over a period of next 3 to 6 months time once the entire expansions are going to complete. We have done a LLP investments, which is going to have around 6 crore rupees in last 6 months what we have done, and other IT and other capex investment which has happened to around 3 crore rupees, which leads to a total 46 crores of capex spends which we have done. And depending upon the best leverage what is available, we evaluate whether we go with the equity or cash available, or we will evaluate with the debt which is available at a best market rate, and then we take the decisions for the interest of best to the interest of our shareholders. Yeah.
My question is also that is this amount going to reduce in future, or is this amount going to stay as it is in this financial year? And what is the investment required for Tanzania project?
So that I have already shared. As I said, in H2, we anticipate to spend another 5 crores to replace the machine, and another 5 crores for our physical infrastructure and IT. So that is 10 crores, and our international expansion, which is primarily Tanzania, is another 10 crores.
And what about in the next financial year?
In the next financial year, I would think, again, depending on the maintenance capex and all, I'll be able to give you a more concrete guidance, towards the latter part of the year. But if you force me for a number, I would say it would be in the 50 crore range.
50 crore?
Yes.
For the whole year?
Remember, I have a lot of old aged equipment even in the NHL business, for which will have to replace those equipments over time.
Okay. So are we thinking of taking some more term loan, or we can manage these investments?
So currently we are not foreseeing on the more term loans, but it's open opportunity depending upon the business capex investments what we are going to happen. Based on the best available options, we will evaluate. Currently we have 30 crores of debt in our books, which is having a tenure of 3 years against the assets. There is no bank guarantee, no collateral security attached to that. In subsequent capex investments, maybe we can go, but as of now, we have enough cash, and immediately next 3 months to 6 months time, we are not planning to go for further debt funding. Yeah, and again, I wanted to once again just reiterate, our balance sheet is very strong. Our cash flow is also very strong. Because we are a healthcare company, we get preferential rates as healthcare equipment finance. I don't see anything wrong in taking debt to finance healthcare equipment for our expansion. In fact, I feel using shareholder money to finance equipment is perhaps less prudent.
No, I understand the point, but I just wanted to evaluate how much dividend will be getting in future. Like earlier 2 years back, we took it 25%. Now we reduced to 18%. I think we don't foresee an increase in dividends in future, I suppose.
No, I would not expect an increase in dividends in the future.
Okay, thank you.
Thank you. We have our next question from the line of Anish Deora from Nomura. Please go ahead.
Yeah, hi. Thanks for the opportunity. Firstly, I just needed a clarification. I was looking at the PDF slide 9, where we have shown the breakup of the pathology revenues quarter on quarter. So in the footnote, it has been written that Q1 FY24 and Q2 FY24 refer to non-COVID numbers. And all numbers except Q1 and Q2 of FY24 refer to non-COVID numbers. So I just wanted to understand if any COVID revenues are there in these 2 quarters, and if you can quantify the same.
Yes, just give me 1 second.
Yeah, sure.
See, see, these numbers are largely our non-COVID numbers. COVID numbers are almost negligible at this point in time. So we didn't see any reason to really bifurcate it at this point. I mean, Aditya can share. Aditya, what is our COVID number for this quarter? I think it's less than 1 crore, right?
38 lakhs for quarter 2.
So yeah, our COVID number, Anish, is 38 lakhs for quarter 2.
49 lakhs.
So we didn't bother bifurcating it at this point.
Understand. And can I just know the COVID number of Q2 of FY23 in that case?
2 crores roughly.
Okay, I see. Understood. Secondly, I just wanted your comments around, the pricing in the industry currently. Have you taken any price increases, and what is the quantum of growth that we are seeing is through price? Just wanted to understand the dissection between volumes and price growth that is currently there.
Yeah. See, for us, we are taking price up through mix. We are not taking price up through price hikes. So our price hikes have been marginal, I think, to the range of about 4 or 5%. The rest we've actually been driving through mix, which is, to larger and larger Arogyam packages, Janch, the newer test menu, more movement towards vitamins and all of that. So I would say, if you see, we grew, about 20% by revenue in our franchise business. I think about 8% by volume. So roughly about 12% is price, which is about 4 or 5% has come from, just price increase, and the remaining has come largely from mix.
Understand. And the price increases have been taken on the entire portfolio or only on some specified portfolio of tests?
So we've taken the price increases across the board. There are just a few loss leader kind of tests that we have, which kind of brings the customer through the door. Over there, we have chosen not to raise the price.
Understood. Okay. Thanks.
Thank you. We have our next question from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, thank you for the opportunity. I think the CapEx question got answered. One question on the nuclear business. How should this business grow, and what are the sustainable EBITDA margins for this business?
See, the business, as I said, one, we are faced with a few headwinds in nuclear, to be quite candid. As I said, the machines are very old, so the cost to maintain those machines is just going up and up, which is what you see, in the other expenses over there. As a result, we have been steadily also increasing prices, in line with that to cover the cost. But that naturally has an impact on the volumes as well. I would say, if I were to guide you, a normal EBITDA for this business, given the state of the machines that we have and, the kind of, OPEX that goes into maintaining and running these machines, I would say in the between 10 and 15% range is where you should, look at NHL on a steady state. We are doing a lot to fix the business, but I would say don't anticipate anything more than between 10 and 15. If we touch 15, I would say we would have done a fantastic job with the kind of infrastructure that we have.
And a related question, as you also mentioned on volume, I think just wanted to know the sustainable growth here. The revenue growth in first half, I think, is 10%. What was the volume growth here? Like, if you could share number of scans for first half, that will help.
For first half versus?
YOY volume growth for nuclear.
Acha. Okay. I think it will be in about 10%. The total scan volume will be about 10%, is what I think, which is where we've landed year on year in revenue.
Okay. So, but you mentioned price hike, so I just wanted to clarify that. So the growth in NHL is driven by
now. No, the price hikes we started now because we started in September and actually now going into October, November. the reason we started to do the price hikes is when the CMC costs started to hit us. And as you know, it's not easy to take price up in this business. So it takes a little bit of time to, ensure it lands.
Got it. Thanks for the clarification. Another thing was, we obviously a lot of pharmacy shareholders have got their forms for rights issue. My sense is legally that process is going through. For us, from a business perspective, API partnership, would you expect that business to revive back on the growth path? Any color could you provide on this?
So I'm hopeful. I think it has already been publicly declared, so I can quote it that the rights issue, has been oversubscribed. So I would hope that, now that some of the funding issues at pharmacy are resolved, that they would also go back on a full growth trajectory. As you know, our entire API business is just cross-selling on the diagnostics platform, on the pharmacy medicine platform. So as that medicine platform goes back on its path to recovery, our cross-sell business obviously goes lock in step with that. So I'm very hopeful that with this funding issues behind us, the third engine of Thyrocare will now start to fire. Our first two engines are firing quite well. The franchisee business, as you've seen, Rahul, has grown at 20%. Our partnerships business, excluding API and government, has also grown at 22%. In fact, surprisingly, even our D2C or our direct business has grown at 19%. The last engine that we have is the API cross-sell, where I'm hopeful that would also come back on its original growth trajectory.
Got it. And Tanzania overall investment is going to be 20 crores, 10 is done, 10 in second half. Is that correct?
No. We've not done any investment till now. It will happen in the second half. That's all we will plan to invest.
Okay. And lastly, just one clarification. I think you answered partially, but I wanted to clarify. Provision, the line reads in your presentation. The provision for receivables taken for foreign accounts after netting off reversal from B2G business. Could you just explain this, please?
Sure. So as you know, we had provided quite heavily for the NHM business, which, we received the money. So there was a provision that was released from the P&L. However, as per our normal policy, our receivables from Thyrocare Gulf has been pending for a significant amount of time. And we have now gone into litigation. So therefore, our advisors have asked us to, or our auditors have insisted that we provide for that. So these two have netted each other off and landed at about that 1.36 crores in the P&L.
So the Thyrocare Gulf receivable is higher than 1, and whatever releases happened from NHM is also higher than 1, right? And hence the net number is 1.5. Is that correct?
Yeah. It's I think about 5 and 6.
Yeah, correct. So around 6 crore rupees of Thyro Gulf, which is netted up against the NHM and few other small receivables.
Get it. Fine, that's all. I'll come back in with you. Thank you so much. All the best.
Thank you. We have our next question from the line of Ashutosh Parashar from Mirabilis Investment Trust. Please go ahead.
Hi, sir. Thanks for the opportunity. So just had a couple of...
Can you use your handset, please? You're not clearly audible.
Yeah, is it better now?
Little better. Please go ahead.
Sorry for that. So thanks for the opportunity. I had a couple of questions. So first regarding, we had initiated this PIN code expansion like 4 or 5 quarters back. So I wanted to check whatever new areas that we have entered into in these last 4 or 5 quarters, how have those been performing? And if we were to sort of index it to a mature area, so currently what level would these areas be operating at? So that is the first question.
So if I could repeat your question so I've understood it, you're asking what is the status of the pin code expansion and where do you think it will reach?
And how has those areas been performing for us? The new areas basically.
Yeah. So, look, we continue to expand in the pin codes, through our pin code expansion team. We actually now have started to track it from number of active franchisees. So we closed last year, I report it on an annual basis. I don't report it quarter on quarter. But last year, if you remember, we had ended at about 7,488 active franchisees. And we continue to add franchisees at a run rate of about between 100 and 135 per month, depending on the month. So I would say in July, August, September, net, we would have added about 400 new franchises. I think we will peak out at about 10,000. Of course, every new, it's like same store sales growth in a retail business, right? The new franchisees take a little time to scale up. So obviously in the first year they operate at about 25% of the full potential of the base. And then it takes them about 3 years to reach the full potential. So it takes a little bit of time to scale up, but we are running at a healthy run rate over there.
Got it, sir. And secondly, on the Arogyam portfolio, so currently what is the total contribution of Arogyam portfolio to total sales?
Sorry, could you say that again?
Second one is on the Arogyam portfolio. So what is the contribution currently to our total sales?
Arogyam remains at 36% of our turnover, which is the same as what it was last year.
And the Pro and Plus range that we have launched a couple of quarters back. So is it contributing meaningfully? Would you be able to quantify the contribution?
See, we have now a full lineup. It is Arogyam, Pro and Plus. Is all part of the Arogyam. They are just, how do I describe it? A completion. At that point, our Arogyam average order value used to be about 1,200 rupees. Over time, it is moving up, in that way. But we had also at the same time launched Arogyam Mini and Arogyam Basic, which were at the entry level. So at a mix level, I would say we are kind of at the same place. But I would say our franchisee business has grown at 20% year on year, and Arogyam remains at 36% of our overall business. So, the Arogyam business continues to grow at a strong clip of about 20%. Most of that driven by our investments in Plus and Pro, because we haven't done anything else with Arogyam.
Got it. That would be all. Thank you.
Thank you.
Thank you. We have our next question from the line of Siddesh from ICICI. Please go ahead.
Yeah, thanks. Thanks for my question. So my question was regarding this depreciation policy. So if you look at plant and equipment, diagnostic equipment, you are depreciating that over 13 years. But you mentioned that some of the old assets that we replaced, those were having average year of 12 years. So is there a need to revisit this depreciation policy of 13 years?
I'll let Alok take that.
We will go through the policy and come back on that. But the current policy, what we are having of 13 years asset life, which we are taking for our accounting purpose, is remain valid. But point taken, we will evaluate. But on an average, our machines are having a life cycles of around 13 to 15 years.
So just to clarify also, I just wanted to say the average age of our equipment was 12 years, right, before we bought the new equipment. That means, of course, that many of our equipment were well beyond 13, 14, even 15 years. Yeah. So, it's those equipment that we have replaced. It doesn't mean that, we are not using equipment that is, let's say, 8, 9, 10, 11 years old.
Okay, got it. Thanks.
Thank you. We have our next question from the line of Meg Shah from Prospero Tree. Please go ahead.
Yeah, I just wanted to confirm one thing. As on 31st March 2023, the total outstanding net of impairment was 83 crores, of which 72 crores were outstanding from government. And right now, the total amount outstanding from government is 10 crores. Is my understanding correct?
Yes.
So in the quarter one, we received 38 crores, and in second quarter, we received 24 crores.